Nijoe is one of the leading tax consultants in India. Basically, he's concentrating on a new tax regime and the old tax regime in today's conversation. So we'll have this conversation in English because there were many requirements coming as comments to us to have this in English. What kind of investments can be done to save tax? So over to Nijoe to give us more advice on these aspects.
And I welcome all the viewers and subscribers of Media Mathamgi to this session. And thank you very much for the support given for our previous sessions. With this session, we'll make sure our viewers will be able to understand what is the new and old tax regime and how they can do their tax planning or reduce their taxation, especially in case of salaried employees. Now, I will start with the new and old tax regime. There are three components in that actually. First one, till 5 lakh rupees, if anybody has got income below 5 lakh rupees, there is no tax applicable as of now in India. Till 5 lakh rupees. In case if your salary is above 5 lakh rupees, then you have to select either the old tax regime or the new tax regime, and you have to start paying taxes. So let us not confuse on that actually. This exemption of entire 5 lakh rupees is applicable only if your total income, that is net taxable income, is less than 5 lakh rupees. In such case, you don't pay any income tax to the department. Now, if your if your net taxable income, net taxable salary, if it is above 5 lakh rupees, you are supposed to pay tax, and then you have to select either the old tax slab or the new tax slab. Now, let us understand what is the difference between old and new tax slab. Now, if you see the new tax slab, the taxation is less in that, but at the same time, government has removed all the exemptions what you used to get in your old tax regime. That is, I'm talking about the ATC exemptions of PF or LIC and all those. We used to enjoy the benefit of all those deductions or your allowances, your HRAs, housing loan interest. So you will not be able to get any of those allowances or deductions in the new tax regime. So in the old tax regime, till 2.5 lakh rupees, you don't pay any tax, and you pay 5% tax on your income, net income from 2.5 to 5 lakh rupees. And from 5 lakh to 10 lakh rupees, you pay 20% tax, and above 10 lakh rupees, you pay 30% tax. Now, when it comes to the new regime, you have more benefit when it comes to the tax slab. Till 2.5 lakh rupees, it is exempted. From 2.5 to 5 lakhs, it is 5% tax. 5 to 7.5, it is 10%. 7.5 lakhs to 10 lakhs, it is 15%. 10 lakhs to 12.5, it is 20%. 12.5 to 15 lakhs, it is 25%. And above 15 lakhs, it is 30%. So you see, there is a lot of reduced tax applicable in the new tax regime. But unfortunately, now the new tax regime, in the first glance, it looks very attractive. But at the same time, you should see in detail whether it is going to be beneficial for you or not. Now, how do you understand that? If your exemptions, that is, I'm talking about the allowances and deductions, that is your HRA, your housing loan interest and principal, your LIC and PF, everything together, for whichever component you get exemption. If that is above around 2.5 lakh rupees, then I don't find there is any benefit with the new tax regime. You can still go ahead with the old tax regime itself. But in case if you are somebody with a very less investment portfolio, like your tax exempted portfolio, like you don't have a housing loan, you don't have a LIC policy and all those things to be exempted, then it is always better to go with the new tax regime where it is calculated on your gross salary and you will be taxed very less comparatively. Now, so that is an approximate figure which I gave you, the 2.5 thing. You can always go to the Income Tax Department website, www.incometaxindiaefiling.gov.in, and you get a tax calculator over there, and you will be able to decide yourself whether it is better to go with the old tax regime or new tax regime. The old tax regime used to give a lot of exemptions, which we will discuss in the due course, and then you arrive at a net taxable salary after all those exemptions, and then you calculate the taxes. Whereas in the new tax regime, you don't get an opportunity to deduct anything. It is directly on your gross salary. You will be calculating the taxes. In the new tax regime, the main benefit is you don't need to submit any documents for that, because basically it doesn't allow any allowances or any deductions from your salary. When it comes to the new tax regime, you will not have to submit any of these documents. It is document free. Fine. So here we discussed three things over there. One is people who get income less than 5 lakh rupees, it is completely exempted. And people who are getting above 5 lakh rupees, you have two options. One is the old tax regime and one is the new tax regime. You can opt from there. Now, what is the next step when it comes to tax planning? Now, as a tax consultant, we keep on getting inquiries like, how do we reduce the taxes? Every time when they get an increment, this is the first thing what we see. Or when they file their income tax return, there is the first thing what we notice. Okay, I'm paying a lot of taxes. Is there any way to reduce it actually? Please understand something. Actually, we will not be able to, make your tax liability nil. Okay, in case if somebody tell you, and I mean, it depends upon your salary. And there are a lot of things. If someone come and tell you that I will be able to reduce a lot of tax liability, please don't believe anybody and go and invest somewhere and all those things and all. You always try to understand by yourself how to reduce your tax. So in this session, we will discuss few more things which will help our viewers and subscribers to do, or find it themselves how to reduce the taxes, or whether you are eligible to reduce the taxes and all those things. Actually, in the next session, we will help you to understand how you will arrive at your net taxable salary. Here, I will split your salary into two different components: taxable allowances and non-taxable allowances. So, as an employee, as a salaried SSC, you should be able to understand what all the components of your salary. If you understand the components of your salary, I'm talking about the salary components are basically the basic salary, HRA component, and there will be travel allowance, conveyances, a lot of things are there. In those components, actually, there are many allowances which are non-taxable, provided you submit the proof for all those things. For example, HRA, as far as you give the PAN card details and the rent receipts, etc., your rent HRA will be exempted by your employer. If you don't, then they don't do that. So it is always the first thing, you should get into the components and then make sure wherever you are eligible, you should be able to get the exemption for that. Now, second thing is actually, if the component is not available in your salary, it is always better to discuss with the employer and find out if you can include it. For example, there is something called leave travel allowance. There are many employers who doesn't include that in your salary component, but it is something which you can get an exemption. So why not? You can discuss with your employer and then try to include those things. And there are a lot of things. The LTA is applicable twice in a block of 4 years. Twice in a block of 4 years. So the same way how we displayed the new and old tax regimes, we will also we are displaying here the allowances which you can get exemption. Viewers, I request to the viewers to just go through all those allowances and find out whether they'll be able to take any benefit out of that. Now, here is a list of all the allowances which can be exempted. The main allowances will be house rent allowance, children's education allowance, hostel expenditure, transport allowances, and research allowance, uniform allowance. Like that, there are plenty. You can find out almost like, I don't know how many numbers. There are many allowances which can be exempted. The next is try to find out which all way you can do some investments or spend your money where the amount is exempted from taxes. Now, I think almost all the salaried employees invest in your normal employee provident fund, which is exempted from the tax. So you all know that 1.5 lakh rupees is exempted. So everybody try to fill that 1.5 lakh rupees with some other investments like LICs or children's tuition fees and a lot of other things. So that 1.5 is something everybody knows. Okay. Now, Section 80C, 80 triple C, 80CCB1, all these three sections together, we have an investment cap of 1.5 lakhs. So that includes your all this kind of provident fund, public provident fund, VPF, life insurance, tuition fees, LICs, housing loan principal, pension plans, and national pension scheme employee contribution. And all these things together, there is a cap of 1.5 lakh rupees. Now, over and above this 1.5 lakh rupees, what all things we can do? Now, first one which comes to everybody's mind will be housing loan interest. Housing loan interest, as of now, we have an exemption of 2 lakh rupees for an individual. So that is something which is separate. Anybody who want to go for a house with a loan, then you get an exemption of 2 lakh rupees for the housing loan interest. Every year you get that exemption. Now, over and above that, actually, you have other options like your medical insurance under Section 80D. You will be able to do take medical insurance for yourself and your family, or even your parents. You can cover it, and you get an exemption for that. As of now, the limit is around 25,000 rupees, and for parents, if they are senior citizens, it is 30,000 rupees. Like that, there are many more expenditure what you can claim for tax exemption. The main one, I'll just read it for you. One is 80D, which is medical insurance, I already covered. 80DD, rehabilitation of handicap dependent. 80DDB, medical expenditure for self or dependent, not for all the diseases. There are all specified diseases are there. Only for those things we will be able to get exemption for that. 80E, interest on education loan, and 80EE, housing loan interest for the first house. There is an additional benefit actually given right now by the government for the first house, that is for 50,000 rupees. And even recently they have introduced something called 80EEB, electric vehicle loan insurance. Okay, and 80G, basically donations to either charitable institutes or political parties, or even to your chief minister's fund or prime minister's fund, etc. So all these things are exempted. So if you are doing something, for example, if you are doing a donation to somebody, if you are able to find out somebody who has got an 80G exemption, then it is exempted. That much, that money what you spend, I mean, for a charitable institute is 50%, they'll exempt it. So you can always see where you get an income tax benefit and then do the investments or maybe the expenditure. So that is something. And there is something above, over and above 1.5 lakhs is your national pension scheme employee contribution, which is 80CCD 1B, where you can invest around 50,000 rupees into national pension scheme, because now even private employees also can invest into national pension scheme and get the benefit out of that. So 50,000 you can invest every year and you can get the benefit. Now, over and above that, there is something more in national pension scheme, which is called 80CCD2, which is called National Pension Scheme Employer Contribution. Now, this employer contribution, which has got, there is no monetary limit as of now defined for that, but basically 10% of the salary. Until 10% of the salary, you will be able to give it as an employer contribution to national pension scheme, and that amount also will be exempted. So this is also something which you can discuss with your employer. This is actually a long-term thing, which the amount will be paid to you or maybe paid into a pension fund when you become 60 years and all. So you can always go in detail about the national pension fee, which is a very good thing actually. As far as a private employee is concerned, right now we are recommended to do that. And then you can discuss with your employer whether he will be able to do this for you. Of course, the employer may not be contributing, but he will be able to contribute it on behalf of you by deducting, adding in a component there for you, and then you will get a benefit out of that. These are the expenditures or investment what you do, and then those amount will be deducted from your income to arrive at your net taxable salary. Now, when it comes to the investment part, there are many questions asked by my clients. Which product to be invested, which company to be invested. See, it's not the question of companies or where to invest, which product and all those things. Always see some logic out of that. There are clients actually who book an apartment just for the sake of getting a 2 lakh rupees exemption from housing loan interest. But you see, they are taking an apartment worth which is around 60 lakhs or maybe 1 crore rupees. And finally, you are getting an exemption only for 2 lakh rupees on the interest, which I don't find it is a big thing to do, or maybe a wise thing to do. So whenever you do an investment, actually, just don't think it is only for exempting taxes. The same way how you get into insurance traps. There are many insurance companies right now. I'm not blaming anybody over here. There are many kind of products available with them. So it is up to you. You have to find out actually what is the kind of return they are going to give it. Actually, whether it is worth investing there. You're locking your fund for maybe 5 years or 6 years or 3 years minimum over there. So whether it is worth, whether your investments are guaranteed. There are instances actually you invest 1 lakh rupees to save maybe some 10,000 rupees of interest, and finally when it is on the maturity, the person doesn't even get 50% of that. Actually. So what is the point of saving a tax over there? You might as well pay the tax and be happy at home, like that. So these are the things actually people should get out from, remove from their mind. Just for exemption, actually, I go and invest it somewhere. Please, take that out from your mind and try to invest wisely. Now, somebody who I feel with the new tax regime, you have more options to invest because there is no investment required for your tax exemption. You have all the liberty to go and invest anywhere. You find the product, which product is good in the market. When you say good product, you can always see the history of the performance of the product. When you are investing in a mutual fund, you have now internet, data access, everything. Any mutual fund you take, you see the history for the 10 years or 5 years or 2 years. You will be able to find out how they performed in the last 5 years. Then you can easily invest over that. You don't need any consultant to help you out of that. Actually, many people consult an insurance agent or maybe an insurance advisor to help in reducing taxes. Actually, see what happens is actually, okay, good. They may know about the taxation, and also they may help you to a certain extent, but finally they will try to push their product. Actually, they will not be able to guide you on the best product available in the market. Actually, so it's always good to understand which is the best way to reduce the taxes and try to do it yourself. And in case if you have some doubts, you can always see online or maybe consult somebody and do your tax planning.
We have discussed about that 1.5 lakhs. You can save up to 1.5 lakhs, and in over and above that, over and above the 1.5 lakhs, you can have this NPS for up to 50K.
NPS.
You can invest,
NPS.
and from the employer side, and from the employer side, there is this 10%. So in case somebody is leaving the job from changing the employer, what will happen to that investment that we are doing?
All your investment in NPS goes to a fund manager. Okay, there are around, I think, 5 to 6 fund managers as of now. So that particular fund is not managed by your employer, actually. So it goes to a separate fund manager. So your fund is safe with them. Okay. So even if you shift the employer, if the second employer also agrees, okay, you can continue. Otherwise, the existing investment is safe there. Actually, only thing is that the options to withdraw in between is not available right now. You have to wait till you are 60 years of age, and then withdrawal and maybe reinvesting into the pension corpus and all those things are applicable. Actually, okay. Having said that, I just want to mention one more thing is actually don't think NPS is a very safe investment also right now, because they also the fund managers are most of them are private players, and they also invest into equity. But the only thing is that the exposure in equity is quite less compared to equity mutual funds and all those things. So to a certain extent it is good actually. But anyway, as far as a pension scheme, we always recommend NPS for the private employees.
And one more thing about the PF which the employer contribution and the employee contribution which happens. So basically, say like when someone changes this is totally a different topic basically, because when we change the employer, what will happen? Like is it better to withdraw the PF or transfer it? What is your suggestion on that?
Talking about the normal PF.
Normal PF.
Correct. Okay. So now you have the option to withdraw, but you see, understand one thing actually. If your PF is 5-year-old, okay, then it is non-taxable when you withdraw right now. Okay. But if you withdraw your PF actually within 5 years, then it is taxable. So that thing what we have to keep in mind. So if that is the case, it is always suggested actually keep on transferring it to the new employer. The same thing can be transferred right now very easily. So you keep on transferring it to the new employer, and then your fund is safe. And also one more thing you have to understand that interest percentage given by the PF department, PF fund is always higher than the bank rates. So it is always safe for you to keep the funds there itself. You have options to withdraw it completely also when you resign and come out actually, or you can transfer it. In between, if you want to withdraw, there are some conditional withdrawals available actually in case of construction of a residence or maybe marriage and few things. They allow you to partially withdraw the amounts also.
Along with that, can you also give some cues about what are the safe investments for a normal salary drawing employee?
When it comes to safe investments, okay. Now, when somebody want to invest somewhere, first thing what we see is actually what is the risk-taking capacity of that person. It all depends upon what is their age, not just depend upon what is their salary. Because if a person is young or maybe less than in his 20s or 30s, maybe his risk-taking capacity is more. He will be able to invest into more riskier product actually, where he may or may not get higher returns. So, example, if you invest into mutual funds, you can always invest into mutual funds, which are equity mutual funds. The returns are very high, but if there is any market crash, stock related issues, you have all the chances of losing your money invested also. So there is no guarantee for investment. When it comes to safe investments, the first thing which come into our mind is provident fund, and you have something called variable provident fund, VPF, which you can always again discuss with your employer and ask him to invest a partial amount to the same amount of PF, employee provident fund, into VPF also. You have an option for public provident fund, which you can go to any banks and open a public provident fund account, which will be locked for around 15 years or okay, so which is also very safe. Only thing what you have to see is the lock-in periods are too much over there. Okay, but if you're looking for a safe investment, it is a safe investment. You have nowadays FDs, fixed deposits in the bank, especially for tax saving. ATC exempted tax savings, fixed deposits are available. They are very safe. Only thing is in FDs, whatever interest you earn from that, that is again taxable. So let's say you invest 1 lakh rupees or 1.5 lakh rupees in FD for saving tax. Whatever 10,000 rupees you get as an income from that is again taxed by the department. When it comes to insurances, there are insurances available, various kind of insurance available. I always prefer insurance as an insurance and not as an investment options. Now, the problem now is actually there are a lot of equity linked insurance products available in the market, which are good also. I'm not telling it is bad. But then when it comes to insurance, you always keep in mind actually it is to save yourself and your family, not as an investment option. I do not consider it as a big investment option. Now, there is something called an endowment policy, which is our traditional insurance policies, which you invest, let's say on you pay as like an EMI, like every quarterly or yearly, you pay an amount, and at the time of maturity, you get the sum assured amount along with the bonus. But if you actually calculate and find out actually how much profit you make out of that, it will be very less. But only thing is your family is safe. And whenever, as and when you take an insurance, from that time onwards, your life is covered. If something happened to you, your family has got some, some fund available with them. Now, this new generation insurances, which is basically equity insurance, the negative sides over there is point number one, there is no guarantee on the investments. Nobody is providing guarantees. Second, there are a lot of hidden charges also. I'm not telling all the funds. So there are many cases where there are a lot of hidden charges. Whatever you invest, only maybe the half of the amount has been invested, and the investor knows about that only at the time of maturity, like that. At the same time, if your risk taking capacity is more, you can always go with such products. Actually, the growth is also very high. I mean, if the stock market goes up, actually your product also grows very fast, like that. So those are the risk factors. So it depends upon the age and your income earning capacity and all those things. Actually, you can always try for all those things.
So I think more or less we have covered the tax benefits and whatever
Mhm.
investments are possible.
So I hope this session was helpful to our viewers and subscribers. If there is any clarification, you can always comment here, or you can contact us anytime for any clarifications. So we have discussed about the two tax regimes or tax slabs, which will help the viewers to select or choose the right one. And then we discussed about the allowances which can be exempted from your income. The third thing is actually the ATC or investments which you do, investments or maybe an expenditure which you do, which can be exempted for taxes actually. So I hope this will definitely help you out in the future to exempt the taxes. Now, what we are discussing right now is for the current assessment year, which is assessment year 2021. So every year the tax slabs and tax regimes may change. So next year we are not sure whether it is going to be the same tax slab actually, but definitely we'll come back with you. If there are any updates, we'll come back with the updates. Thank you very much.
Sure. Thank you so much, Nijoe. I think in the next session we can cover about whatever the NRIs need to take care of, and maybe we can also give some insights for the pensioners, what kind of tax savings and how what kind of investments they can plan
Mm.
about.
Mm.